Is your retirement savings a ticking tax time bomb? Most are unaware how much tax they could pay in retirement, which means likely no planning has been done to lower those future taxes. So in today's video, I'm going to explain this concept called tax diversification. Now, whenever we hear that word diversification, we often think about diversification within our investment portfolio, which can be quite valuable. The purpose of being diversified with your investments is to eliminate the unnecessary risks of picking wrong. So for example, instead of figuring out which stock will perform the best, you can simply buy all of the available stocks, which spreads out your risk across every company rather than placing your bets on one singular company. So that's why you would want to diversify your investments. But since this video is about tax diversification, how do we apply this concept to your taxes? Well, the first thing we have to know is that there are generally 4 different types of income that you could have in retirement, and subsequently 4 different ways that your income could be taxed. And how each type of income is taxed really boils down to where that income comes from. So the first type of income that you could have is any distributions that you would take from your traditional IRA or 401k. Any money you take from a tax-deferred account will be taxed as normal income, regardless of how long ago you put that money into the account, and it doesn't matter if it's principal or growth. So every dollar is taxable as normal income when you make a distribution. You didn't have to pay taxes when you contributed the money to the account, so you're gonna pay taxes whenever you take money out of the account. This account type is often the biggest problem for retirees, and I'm gonna show you why here in just a moment. The next type of income is money that you would take from your Roth IRA or Roth 401k. You put the money into the account type after you paid income tax on it. So if 2 rules are met, you can take money out of the account without tax or penalty. Those 2 rules are that you have to be 59 and a half and the account has to have been open for 5 years. Now, it's important to know that you can actually take out your contributions at any point, regardless of your age and how long the account has been open. So the 2 rules that I just mentioned are really referring to the growth that would take place in the account. So if you put $5,000 into a Roth IRA and it grows to $7,000, you can take that $5,000 out at any time, but the $2,000 of growth, that is subject to the 59 and a half and the 5-year rule. If you take the growth out before those 2 rules are met, you're going to owe normal income taxes on the growth, and you're going to have a 10% early distribution penalty on that amount. Also, your contributions are always the first dollars taken out. So using that example we just talked through, if you took $5,000 out of your Roth IRA, you would pay no tax or penalty because the growth is distributed last. Now, I know that that's a bit technical, but these technicalities are often misunderstood, so I wanted to make that clear. The third type of income in retirement is interest or capital gains that could come from cash within your bank account or investments in your brokerage account. These types of accounts are often referred to as a taxable account type. This just means that they are not tax sheltered like an IRA or Roth IRA, and that taxes are paid annually on the interest or dividends or capital gains in both your bank accounts and your brokerage accounts. What's interesting is that interest, dividends, or realized capital gains from these account types, they can be taxed in either one or 2 ways, either as normal income or as a long-term capital gain. So what's treated as a normal income? Any interest on cash, bonds, CDs, high yield savings accounts, etc. Really anything that's interest bearing. So what's treated as a capital gain? Well, any investment gains that you realize or create by selling an investment after it's risen in value. So for example, let's say that you bought a mutual fund that went up by $20,000. That gain of $20,000 is not taxable until you sell that mutual fund. By selling, you are realizing the gains, and those gains now become taxable. What's important to know about capital gains is that they can actually be taxed in one of 2 ways. So we're kind of breaking down even farther. They can be taxed as a short-term gain or as a long-term gain. Short-term gains are when you sell an investment that hasn't been held for at least 1 year. So gains become long-term after the investment has been held for 1 year. Long-term gains receive a more favorable tax treatment as they would be taxed at either 0%, 15%, or 20% depending on your income. Short-term gains are always taxed at normal income rates, which are higher than long-term rates. So that's how taxable accounts are taxed. And the fourth and final type of income that you could have in retirement is Social Security income. I won't dig into the details of how Social Security income is taxed or calculated right now because that's that's a completely separate video. But just know that not all of your Social Security income is taxable. In fact, a maximum of 85% of your Social Security income is taxable, but it could be even less than that depending on how much other income you have. And here's a cool fact for you. If Social Security is your only income, you won't pay tax on any of it. Again, I'll do a separate video on how Social Security income tax works, but those are the 4 types of income that you can have in retirement. So with that framework, let's take a look at an example to see this in action. Let's assume that you're 63, you're married, you're retired, and you need $100,000 of income to meet your needs. The first example I want to look at is if all of your income came from your traditional IRA. So in this case, you would have a taxable income of $70,800 after you subtract out your standard deduction. And after you run your taxable income through the tax brackets of 10% and 12%, you would have a total tax to pay of $8,032 with an effective tax rate of just over 8%. So this is a basic example, and this is how many retirees end up having to pull income in retirement because 90% or more of their retirement savings is actually in a tax-deferred account. For the second example, let's assume that everything is the same except the $100,000 doesn't all come from your traditional IRA. 50% comes from your IRA and then 50% comes from a Roth IRA. In this situation, you're still getting $100,000 in total income, but your taxes will be much less because only $50,000 is actually subject to taxation. So after we subtract out your standard deduction of $29,200 from your income of $50,000, you're left with $20,800. All of that amount falls within the 10% bracket, which results in a total tax paid of $2,080. So this is much less than the original scenario whenever you had $8,000 in taxes, and it's all because of a change in where your income came from. And for the third example, let's assume that everything is the same, but this time, let's say your income is split between 3 different sources. 34% comes from your IRA, 33% comes from your Roth IRA, and then 33% of that $100,000 comes from your brokerage account where you have a long-term capital gain. So you have $34,000 coming from your IRA, $33,000 from your Roth IRA, and then $33,000 from your brokerage account. And the $33,000 that's coming from your brokerage account, that is made up of $20,000 of principal and then $13,000 of long-term capital gains. So out of the $100,000 of gross income that you're receiving, the $34,000 from your IRA is taxable, the $33,000 from your Roth IRA is not taxable, and only $13,000 of capital gains from your brokerage account is subject to taxation. This results in a adjusted gross income of $47,000, but the taxes work a little differently because the long-term capital gains are included here. In this situation, your standard deduction of $29,200 is subtracted from your $47,000 of total income, leaving you with $17,800. Of that $17,800, $13,000 is long-term capital gains, which means it is taxed at either 0, 15, or 20%. If we look at the long-term capital gain tax brackets here, we can see that you can have a taxable income of $94,000 before your gains would be taxed at 15%. Since the total taxable income is $17,800 in this scenario, the $13,000 of capital gains, they're going to be taxed at 0%, which basically means your brokerage account just turned into a Roth IRA, which is pretty wild to think about. So after the $13,000 is taxed at 0%, the remaining $4,800 of your income from your IRA is going to be taxed at 10%, resulting in a total tax of $480 on $100,000 of income. Now, this is a high-level overview of how taxation works from different sources, and I'm not even including Social Security income in these scenarios, but it gives you an idea of how powerful tax diversification really is. You had a total of $100,000 each time, but depending on the sources of that income, your tax bill can vary greatly. So how do you get tax diversified? The best way is to save into these different accounts while you're working. So save to your 401k up to the match, max out a Roth IRA each year, and then overflow into a brokerage account. But Jacob, I make too much money to contribute to a Roth IRA. Well, then save to your Roth 401k. But Jacob, I really make too much money and it makes more sense for me to save everything to a tax-deferred account because my tax rate is really high today. Well, that's a great problem to have, which means you can likely max out your tax-deferred 401k and then still do a backdoor Roth IRA and still overflow into your brokerage account perhaps. Having a high income isn't an excuse not to be tax diversified. It actually means you have more of an ability to invest in a brokerage account, which is one of my favorite account types. So that's the best and easiest way to get tax diversified for the future, is to actually save to these different account types while you're still working. Now, let's say you didn't create tax diversification while you were working and saving, so you get to retirement and you have $1 million or more in a tax-deferred IRA or 401k. What do you do in this scenario? Is there a way to get tax diversified after retirement? The answer is yes. You can get partially tax diversified after retirement by doing Roth conversions. Maybe you've heard of Roth conversions before, but in its simplest form, it's just electing to move money, either all or some, from a traditional IRA to your Roth IRA by paying taxes on that money when you convert it. What this does is it reduces your future tax burden because you will have less money to be taxed in the future when RMDs or required minimum distributions roll around, or when your spouse passes away. Roth conversions might not be the right thing for everyone, but it is a way to improve your tax diversification. So hopefully this video shows you the tremendous value of having income in retirement that you can pull from different sources. In fact, the best tax planning you can do for your retirement is where you save while you're working. It gives you flexibility of income if you have a traditional retirement, so after 59 and a half, but it also gives you the opportunity to retire before 59 and a half because there are no age restrictions on your brokerage account, and you can always pull your contributions out of your Roth IRA. So understanding that not all income is created the same or taxed the same allows you to create a tax-efficient retirement plan. If you found this video helpful, like and comment, and if you have any questions, you can leave them down in the comments below as well. I look forward to seeing you in the next video.